Hello everyone and welcome to the show today, the Retire Young audio experience. And today I have a special guest with me as always, Sean Doyle. How you doing today, Sean?
Doing well.
Good. Now, you do a lot of futures trading. You've done a lot of that in the past. Before we get into today's topic, let's talk about how you got started in these financial markets first.
Sure. So I started off I worked on the trading floor at the Board of Trade. I believe it was in late '96, maybe '97. It's kind of a typical story for people from Chicago. I started off as a runner, worked my way up through the ranks, became a clerk, did that for about 4 years, and then had, of course, learned the whole process of how everything works, how to do hand signals, how to communicate efficiently.
Pretty wild out there?
Yeah, it was insane. It was insanity. So did that for a while. Then I actually became a broker first. So I filled customer orders for big banks such as, J.P. Morgan, Swiss Bank, Deutsche Bank. I had hedge fund customers like Stevie Cohen, who runs SAC Capital. We used to fill orders for him. And then did that for a couple of years. Wasn't too excited about being a broker, having to entertain all the customers. And I knew that the majority of the money was on the other side, being a trader, which we call the local. So then I became a local in 2005. Did that. I've been on my own independently ever since then. I was a partner in a proprietary trading group. We came up with trading strategies, hired 10 different people to do that, and did that for a while. And then kind of 2012, I walked away and just been kind of independently doing it ever since then.
Yeah, that's the nice thing about the futures market is, as you know, it's a 24-hour market, and you have leverage or the buying power. Now, when you were on the floor or in that environment, you kind of saw how the institutions trade and invest, right? Was it a little bit different than how the average investor typically trades and invests?
Yeah, I mean, mostly on the trading floor, you'll start to realize that a lot of these guys are hedgers. Everybody has offsetting positions for what they're doing. The average investor is typically just a buy and hold trader.
Yeah.
Where we would just trade both directions of the market, and we were fortunate that we were able to do both sides of that. And back to, like you said, futures markets they're great in the sense that they're open so long, so you avoid gaps. You can manage your risk overnight if you needed to. It's just very beneficial in that way. So
sure. Now, we were having a conversation yesterday, I think it was, and we were talking about the margins in the futures market, how it's really gotten pretty large now for the average investor.
It's very
and
large.
Basically, the margin is the capital that you need up front to basically buy a contract or sell a contract in the futures market. Now, you've been getting into a lot of the micro futures, right?
Right.
Explain what the micro futures are, because a lot of our viewers and listeners don't really know that's available.
Right. So the CME last May, they launched the micro contract. So back in the day when I worked in the trading pit, we had a big E-mini contract, and it was $25 a tick. And then the financial crisis hit, and they kind of all the volume shifted to what's called the mini, the E-mini. So the E-mini is $12.50 a tick. And then last May, the CME launched the micro contract, and the micro contract is only $1.25. It's 1/10 of the mini.
Mm-hmm.
So when it first got started, there wasn't a lot of interest in it. And then as COVID just hit in March, almost, I would say 50% of the volume shifted to the micro contract.
Really?
Yeah.
So you're getting million plus contracts a day, roughly?
About $1 million last time I looked. That was the volume that's traded. Well, the open interest isn't there. For those of you guys who know what open interest is, and that's basically how many people have positions that haven't closed it, and it's typically the institutions that have the open interest. So the open interest may not be there,
sure,
but the volume is there. So the volume is telling me that the average investor who is trading E-mini contracts, or Russell, or Dow, or NASDAQ, half of them have shifted over to the micro contracts.
Yeah.
So it's 1/10 the risk to do that. And the margins, like Josh, you were just saying, spiked up. You could have the E-mini S&P contract, 6 months ago was $6,000 or $7,000 for margin, and now it's almost double that. I think it's $13,200 for margin, and that's for the mini. But if you go to the micro, it's 1/10 of that. So now you're down to $1,300, or it's basically it's a lot cheaper to trade in. So.
Yeah, well, it makes a big difference for the average investor, because a lot of people that are trading in the futures market, some people don't have $10,000, $20,000 accounts. What's nice about those markets is the brokers require less to get in, but if the margins are so high, it's hard for them to get into positions.
100%. And the futures are great markets for people who don't know is that, you're capturing the entire move of the E-mini S&P contract where you don't have to buy a stock and pay a bunch of money for it
Sure.
and try and figure out which stock it is that I want to buy. You're capturing the whole thing for a very little amount of money. So for $1,000, you can capture the entire E-mini S&P contract, which is $165,000. So rather than buying stocks, holding it, putting out that margin, and paying, or having a $25,000 day trade account, you can do all this stuff much cheaper in the futures market. So
yeah, well, it's nice about that too, because a lot of the viewers and listeners probably say, well, why would I want to trade something that's less money? Well, that's less risk, when you put up less capital, but you can buy more than one contract.
Right.
A lot of people think, I got to buy one contract of the S&P 500, where you said 13,000 or so for the margin. Well, you can only buy one contract, and then what if your zone or the area you want to get into is a large area? That's a lot of risk.
Right.
And if you're able to manage your risk a little bit differently by doing maybe a couple different contracts, a smaller position size, that may be better for the average investor as well.
Absolutely. And, especially when the volatility like we're in, like I said, you go back to March, prior to March and COVID hitting, we use ATR, which is average true range. Without getting into that, you can measure in a dollar amount how much that contract moved. And prior to COVID hitting, the E-mini contract was only moving $1,000 a day. And then it went all the way up to 8 times that. I think the high, the ATR went all the way up to 160, 170 times the point value, which gives you the dollar amount. So it was moving then from $1,000 to $8,000 a day if you were just trading the mini. But if you're trading the micro now, it went from $100 to $800. So there's a lot more leverage in there to capture those moves for a lot less money that you have to put up. So
yeah, and those have been around since May is when the CME came out with them.
So it was 1 year.
Almost a year ago.
It was over a year. It was about a year.
Or May, yeah, you're right, yeah.
So, but they have it. It's not just the E-mini that I'm talking about. They have it in the Dow futures. They have it in the Russell, and they have it in the Nasdaq as well. So
okay,
there's a lot of they have a mini crude contract. They also have a mini gold a micro gold contract. So
there's more opportunities out there.
So without having to put up the big amount of capital to do it, you can trade for really little amount of money.
Sure. Do you trade and invest? Do you have any specific contracts that you focus on, or do you kind of trade a lot of different ones?
To be honest with you, and it's one of the things that I talk about is I think people always want to trade a lot of different things. I spent the vast majority of my career trading probably 2 products. So you don't have to trade a bunch of things to be successful. My specialty, because I worked on the floor at the Board of Trade, and all they really had there was commodities and interest rates. Mm-hmm. So my specialty that I do is short-term interest rates. That's kind of what because those were the trading pits that were there that I worked.
You talking about the 10-year and the 30-year bond? Is that?
No, actually even lower than that. So I worked in the 30-year bond for a while. I worked in the bond options, but it was primarily
with was it Baldwin? Is that the guy? Was he there?
Yeah, Jerry Baldwin was there, and then. But I primarily was in the Fed Fund futures, which is only a 30-day rate. And I would trade 30-day rates, and Eurodollar futures is actually an interest rate, which is a 3-month rate. So I would primarily spend my time in there.
Yeah, were you able to see kind of tendencies as well? Because if you trade in one commodity or one interest rate, a lot of people like to see different tendencies. They run similar. Mm-hmm. Were you able to catch some of that stuff?
You're saying the similar direction?
Or the tendencies and how they would kind of run?
Yeah, so the more you trade one particular instrument, the more that you understand the way that it moves. When I traded those interest rate products, I knew when something was off. I knew you get a feeling, it's an intuition, you can almost feel the movements of markets. So when I was in those markets, I knew when there was something off, and it was we did a lot of hedging and spreading, which I'm sure the amateur investor doesn't know what that is, but we would offset our risk by what's called spreading, and we did a lot of that, especially trading through the financial crisis.
Yeah, so basically you were trading one contract versus another,
exactly.
and a spread in between there.
Right, the difference in the price between the 2 different contracts. So it's kind of more complicated stuff, but to answer your question, back to it is that yes, you really don't need to trade a bunch of different products. You can focus in on a handful of them, and that's it. That's all you need to be successful. Like I said, I spent probably 10 years out of my 18 years trading, just in those 2 markets.
Nice. Well, how was your transition from being on the floor to, because it's all electronic now.
Right.
How was that transition? Because you were there when it was probably the tail end of it just being, you know, it was electronic when you left.
Sure.
But was there a transition period where it was tough right away, or how was that transition?
Well, for me, it was, you know, I was fortunate that I was, like I said, I caught the tail end of it because I was younger. So it was an easier transition for guys like me who were, I was still in my 20s. I was familiar with computers, and I was, you know, I understood stuff. So for me, it was a pretty easy transition. But the difference between working on the trading floor and on the computer is that we knew where the order flow was.
Mm-hmm.
You know, we could visually see it. We knew who filled it, and we got what was called the edge.
Yep.
So when you trade on computers, you're giving up that edge. You know, you don't know who's behind the orders. You don't know who's on the charts. So that transition of it was hard in that regard. Is that, you know, you have to basically come up with your own strategy, and it has to work because you're going to be giving up the edge.
Yep.
So I actually had my best years ever were after the trading floors.
Okay.
You know, 2008 especially is when I did the best. You know, when the volatility hit and I was prepared for it. That transition for me though was pretty simple.
Yeah, that's the key is being prepared for any market condition. I mean, people are thinking, oh, 2008, what happened in 2008? I mean, that was a whole financial crisis, but if you're prepared, if you have a strategy and rules within that strategy, that can be a difference in any type of market.
Of course.
So, I mean, it doesn't matter what the market does, you just want it to move. So, I mean, I appreciate your insight on the show here today.
Yeah, no problem.
You know, I hope to have you on again. Make sure everybody to leave comments as far as anything that you'd like to hear next. Also, subscribe to the YouTube channel. But thanks for coming on the show here today. Appreciate it.
Yeah, you got it.
Thanks.